Good evening, friends. Welcome to another edition of Finsherpa's Academy's webinar series, and we are, as you're already aware, that we do this once a month. That is, bring speakers who can add a tremendous value of understanding our understanding on the investment world and how it functions. So in that series, over the past few months, we have got some fantastic speakers, and I'm sure today evening is going to be another diamond that's going to kind of add to that necklace of speakers who have adorned our academy so far. And to kind of not take any more time from the speaker, I'm delighted to welcome Ajith Menon. Thank you, Ajith, for sparing time to join with us this Saturday afternoon on the eve of independence. So hopefully, at the end of this session, we'll have far greater financial independence and knowledge independence, so to say. So on that note, it's my duty to introduce Ajith. Ajith is the CEO of PGIM India Asset Management Private Limited. PGIM is internationally one of the largest wealth management houses and investment AMCs. And Ajith Menon is the Chief Executive Officer of PGIM India. As a CEO, Ajith oversees all aspects of the asset management business, including the mutual fund and the portfolio management services. Ajith is responsible for the direction of the business and its growth strategy. As a dynamic and growth result-oriented leader, he brings to the table keen analysis, insights, and a team approach to drive organizational improvements and implementation of best practices. Ajith is an industry veteran, has over 2 decades of leadership experience in business strategy, distribution, sales, and marketing. He joined PGIM India from Tata Asset Management Company, where he was the head of strategy. Prior to Tata AMC, Ajith spent over 15 years with DSP BlackRock, where he played a key role in the growth of business. He is associated with key industry bodies and is a sought-after speaker at various domestic forums and conferences. He has authored papers on matters relating to the AMC business, co-designed a 6-month certification course on wealth management and a 2-month retirement readiness certificate course for business partners. Incidentally, under Ajith's leadership, PGIM is one of those few institutions that is taken a lot of effort in understanding the retirement industry in India and the retirement readiness industry, so to say, and really bringing in a lot of focus over the last 2 years into that space, because that's a very neglected area, given that we don't have a very strong social security in the country. That's an area that PGIM has been playing a stellar role, and thanks, Ajith, for that. And with no more ado, I'm going to turn over the proceedings to Ajith, who is the hero of the evening. Over to you, Ajith.
Thank you, Babu, for that really kind introduction. I welcome all of your customers of Finsherpa Academy to today's session. It's a pretty unique session because this is not the usual presentation that you will see from CIOs or CEOs talking about markets and the risks about the market and what happened and what is likely to happen and all of that. Even though I'll be happy to answer any questions that any of you may have at the end. From my perspective, in the 27 years of 28 years now of career that I've had, more than 21 of that being in mutual funds, I've had the opportunity of traveling across the country and meeting thousands upon thousands of investors at various conferences, presenting to them, interacting with them, and of course advisors across the country. I can vouch for the fact that Babu is amongst the best of advisors that I've interacted with, and always enjoyed the interactions we've had, Babu, at every occasion that we've had. And therefore today, I'm trying to bring those insights into essentially defining an investor's journey and the kind of issues that typically investors would face, whether you're an ultra high net worth investor or a high net worth investor or a simple retail investor, a novice or an experienced one. We all go through certain challenges which are largely to do with ourselves, largely to do with our own biases, our own, information that we have and the way we interpret it and the way we interact with the world around us. So my presentation is really to, put in perspective what some of those challenges are likely to be. You would recognize some, you may not recognize others. And maybe, and at the same time, I also want to try and leave you with the most important question that you should be asking whenever you encounter any one of these biases along the journey. Now, it's all very nice to talk about biases and behavioral finance is a whole vast area that's developed a lot. But I think, it's also important to put it into a framework so that we can hopefully retain it, as we go forward. I would love it if this was not a presentation that you loved for the 30, 40 minutes that you listen and forget much about it and, maybe 3 days down the line. I would love it if much of it was something that you found useful as a framework that you could utilize in your investment journey. And that's the approach that I've taken. I am actually presenting a framework here, which I found very useful for myself in even planning around our business. This is a framework that is used by the Indian Army while planning missions. And I feel that this framework is so robust that you could use this framework for any aspect of anything that you consider a mission. And here I'm just likening the investment journey as well to a mission and trying to apply the framework to the same. So I hope you will enjoy the presentation itself. It's fun. And it's also something that I hope you will find extremely useful. So let me dive straight into it. And to start with, I am in the agenda. I am essentially going to be talking about taking a leaf out of mythology to start with, and then take you through the Z-Kit bag, which is the Indian Army's mission planning tool. Very interesting one, and I'm sure that you will love it. And how do we use this Z-Kit bag of the Indian Army's planning tool in investing, and then make some conclusions around it and then take it from there. So let's dive straight into it. And like I promised you, I'm going to take a leaf out of mythology. It's a subject that I like very much. It's almost like a hobby. I've read many books around the Mahabharata and the Ramayana. I love the stories there. I'm sure as much as every one of us in India. But I do think that there's a lesson to take away here, which I'm going to be presenting in one single slide, which is more or less an esoteric meaning, as experts call it, from the story of the Mahabharata. So let's go straight into that. And okay, here you go. So I'm starting here with, all of us know this, that, Dhritarashtra is the blind king in the story of the Mahabharata. Now, when we think about an esoteric meaning to the Mahabharata, and I'm sure that you would have heard your parents or your grandparents talk about it, that whatever is in the Mahabharata is in this world, and whatever is not in the Mahabharata is not in this world. It's all encompassed in that mythology, and it has a representation to a human being, a single human being. The whole war is as like it is being fought inside of us. So if you were to take the story and say, this is a war that is being fought on a minute-by-minute basis inside of us, this is how it's going to look. So Dhritarashtra, the blind king, is likened to the brain. If you think about our brain, very powerful, the most powerful supercomputer on earth is up there, but it's blind. It can't sense anything itself. It has to depend on all the sensory perceptions that it can get to make some sense out of the whole thing and reason and then take decisions, right? So our brain is like Dhritarashtra, the blind king. Now you know obviously of the 100 Kauravas who are the children of the blind king, and these are nothing but representative of the negative influences and biases that any human being can have. And I'm sure there will be probably more than 100, but 100 negative influences and biases are represented by the 100 Kauravas. It is in fact said that the worst negative influence that a human being can go through is anger and jealousy, which is represented by Duryodhan and Dushasana. So it is in fact why they are the biggest villains over there in the story, according to an esoteric interpretation of the Mahabharata. Of course, here comes the heroes, the 5 Pandavas, and who may they be in the context of an individual? Our 5 senses of sight, smell, taste, touch, and feel, right? So, and hearing. So the Pandavas, our Pandavas are our 5 senses. And if we are alive to all of our 5 senses, it's the most powerful, way to be from a human perspective, of course, that all our 5 senses are sharp, right? But the 5 senses by itself, doesn't do much. It needs to be kept together with some passion, some purpose. That is when the 5 senses actually, come into their own. And Draupadi is representative of the passion who keeps the 5 brothers together, representative of the human passion, the human purpose that keeps our 5 senses together. Of course, Krishna is the soul. As you know, he's the Sarathi. Krishna is likened to our conscience. And yes, the soul that permeates us, all of us human beings, and guides us on our path, that silent voice in our head and in our heart about what's right and what's wrong, and something that guides us forward. Now, so far, so good. I hope that you found that very interesting as an interpretation of the Mahabharata. To me, when I was thinking about this, however, the most intriguing question was, who's Karna? Because as we all know, Karna is the eldest brother of the 5 Pandavas. He just happens to end up on the wrong side and is killed in battle. Now, Karna is ego, right? Karna represents ego in this sort of an interpretation of the Mahabharata. Ego is part of each one of us. Ego is, even a little baby you will see has a lot of ego. For all of us who have children, we know that, you can have ego as a baby. And well, as you grow older and older, you can be sure that for many of us, the ego is something that does come in the way. But the whole meaning of this, or the whole takeaway from this, is that even though ego is a part of you, it's the most difficult one to overcome, but it is the one to kill. It is the one to subdue, so that we can move forward. So in terms of a summary, here is what I have, that our brain is essentially blind. It's influenced by 100 negative emotions, influences, and biases, which we are going to talk about today in the context of investments. But the 5 senses, with the help of an able Sarathi, and I would liken Babu here to be the Sarathi for all of us at Finsherpa, can win over this, and you have to let go of your ego, or you have to at least subdue it or work on it if you have to win the ultimate war. So with that one simple sort of introductory slide using mythology, I hope that I've set some interest for you on this presentation. But of course, now I'm going to get into a few things more formal and talk about the Z-Kit bag, which is the mission planning tool of the Indian Army. This is something I came across in an article written by Captain Raghu Raman. I'm sure that for many of you here who are quite connected and love to read a lot, you would have heard of Captain Raghu Raman, maybe TED Talks. He's all over YouTube, and some fantastic discourses that he's given in terms of leadership and management and the army and things like that. But it's an article that he wrote about almost 12 or 14 years ago that I remember striking me as something that can be used in every situation. Of course, Captain Raghu Raman was 11 years in the armed forces, been in the corporate life. He was the first CEO of India's National Intelligence Grid. He's the author of Every Man's War, and he's also a fellow of the Observer Research Foundation. Now, one of the things that Captain Raghu Raman spoke about is something that struck me a lot, okay, about the Army's planning process and of the whole objective of having the plan. And he says here, the army's lessons are written in blood because mistakes come back in body bags. So when an army plans for something, it just can't afford to make a mistake, because if they make a mistake, somebody will lose their life. And so they sharpen their toolkit, they sharpen their planning process to such an extent so that they can take care of every contingency. It's a whole approach to planning which can be applied, I believe, also in the investment journey, and that's what we're going to learn about as we move forward. So let me take you very quickly through what does the Z kit bag stand for. It's obviously an acronym, and I'm going to take you through the acronym. Most of the words are Hindi words as the army uses, but here it is. Z stands for Zamini Nishan, or in other words, the theater of war. All the nishan in the zameen, as in when you get down to fight a war, what does the battlefield look like? Am I going to be fighting in the forest? Am I going to be fighting in the mountains? Am I going to be fighting in the desert? Am I going to be on sea and land? What is my territory, the land on which I'm going to fight? Do I know that? Do I know north, south, east, west? And for the army, this is the first step as they plan for a mission, because they need to be prepared for the kind of territory that they're going to be up against, in a manner of speaking. The second step for the army, which starts with the letter K, is khabar, or information. Have you got enough information about the territory that you're going to be fighting your battle in? Do you have enough information about the enemy? Do you have enough information about yourself? Do you have enough information about the tools and the resources that you're going to be using as you're going to be on the mission? So everything that you need to know, you need to know. And that's the second step for the Army's mission planning framework. The third, which is I, is irada. You would recognize this word. It's the goal. What are we going for? Are we going to take out a bridge? Are we going to bring back some of our colleagues who are stuck on the other side of the enemy lines? Are we going to lay down mines? Are we going to simply give covering fire? What is the goal of the mission? That's something very important, but only after you know the territory that you're going to play in and you have all the information about the area that you're going to be in. And then you set your goal step by step. You may not go for the final one immediately, but you set that goal step by step so that you can achieve your ultimate battle. Your next step is T, which stands for Tarika. As simple as you can translate this as strategy. So once you know the goal, so okay, what's the strategy that you're going to follow for that particular goal? There can be multiple strategies. So how are we going to approach it? So that's how the Z kit bag starts coming down. Z-K-I-T. The word B or the letter B in the Z kit bag stands for bandobast. If you know the territory, if you have all the information, you know what the goal is going for, you know what the strategy that you're going to use, what bandobast have you done? What are the resources that you have on hand? What men, what material have you kept ready? That's the B, the bandobast for the army. The next, which is A, stands for administration, which is the only English word I think in this acronym. But this is about the metrics of measurement. How do you measure that my mission is going on track? Am I going too fast? Am I going too slow? Have I got to the first objectives in the time I'm supposed to get there? So all the measurement and the metrics and the back ops that the army would do in terms of keeping track of the mission is done from this step, the administration. The last step, which is G, which is the most interesting one that I found, is Ghadi Milao. G stands for Ghadi Milao. Nothing but synchronize your watches. So when the army and when a platoon goes down into mission, the final step is Ghadi Milao. They have to synchronize their watches with their commander. And the reason they have to synchronize their watches with the commander is intuitively simple. If you're in the theater of war and in battle and you are taking it by the minute, if you're going to be expecting shelling from your side, you better get out of the way. And if your commander is telling you that by 1643, you've got to be moving to the west, and if your watch is running 10 minutes late, well, you're going to be in the middle of shelling. from your own side. So just to exaggerate a point, but that's the importance of Gadi Milao. The final step is, are you synchronized in terms of what you thought about the vision, mission, what you wanted to do, and the way that you're going, and with everything else around you. So, ladies and gentlemen, that's the Z-Kit bag, the framework, and I'm going to take you through each step of this from an investments perspective, and I hope that you will see that there's some relevance to all of this as we take it step by step. Zamini Nishan, Khabar, Irada, Tarika, Bandobast, Administration, Ghadi Milao. That is the Z-Kit bag. So let's now get straight into Zamini Nishan from an investor's perspective. Zamini Nishan, as I mentioned, is the terrain that you're going to operate in, the theater of war. As an investor, you have to familiarize yourself with your terrain. And to me, that terrain is the Indian economy and the global economy. It cannot be one only, and it has to be both. And that's the terrain that you need to be familiarizing yourself with, in some sense, that you know that you're playing in this terrain. Why am I saying this? I'm saying this because investing is all about buying businesses. It's about becoming an owner in the simplest sense, right? And if you're going to buy good businesses, if you're buying good businesses, what is a good business? A good business is simply a growing business. A stagnant business is not a good business. So a good business is a growing business. What is a growing business? One hallmark of every growing business is that it leverages human ingenuity. Let me pause a minute. Let me pause for a few seconds and give you my perspective about equity. Equity is the only asset class in the world that captures human ingenuity and human innovation. It is only later that it flows down into something like bonds and fixed income. And it definitely doesn't flow down into things like gold and real estate and currency and things like that. Equity is the only asset class in the world that captures human innovation. In every field, whether it's healthcare or insurance or finance or metals or chemicals or consumers or auto, it is the innovations that take that sector forward. And the companies that do the best in innovation, is the ones who disrupt the incumbents, are the ones who do better, and over a long period of time, they're the ones who build sustainable wealth. So this is my simple sort of approach to looking at it. And of course, investing is not all about equity. It's about various other asset classes, but I'm just trying to make a simple point when I talk about equity in a sense, and the fact that the terrain that you're going to be in largely is the Indian economy and the global economy. Just as another factoid, may I say that the Indian equity market is a little under $3 trillion, and the global equity market is about closer to now $100 trillion. So we're just 3% of the total world, and there are enough number of companies and sectors and entrepreneurs all over the world who are leading innovation, who are therefore building growing and good businesses. And there are enough opportunities for Indians to invest abroad, whether through Indian funds or directly internationally. And that's the reason why I say that the first step for the investor should be Zamini Nishan. Familiarize yourself with your terrain. Do not limit yourself to just the Indian market. Think India, think also global. And therefore, the human bias that you will encounter, which is the topic of the presentation here, is something called home bias. It is something encountered by people all across the world, even in the US or in other developed markets. People have a home bias. They'd like to just put money in their markets, in markets that they understand, they know, they're close to, they read in the newspapers every day. But it would mean that you would only be narrowly focused on what is visible. So the question you ask in this first step of commission planning is, how narrow or wide is my field of vision as I'm getting into investing? Don't be too narrow. I think it always pays well to be as broad as possible from investor to investor, of course. Let's move to the next one, Khabar. I talked about it as information on the enemy, on stealth. I think the most important way to think about it is that, do you have actionable intelligence? Is the intelligence, is the information you have actionable? That makes all the difference. But now let's look at it. When we think about the step of cover, from your perspective, it is your filter, right? Your filter that you need to use to gauge your enemy. And that enemy for you, in as far as the investment field goes, are probably only these four things: inflation, volatility, taxes, and your own personal biases. These are your four enemies. And you need all information about it. You need to know about yourself, your own personality type, your style, the things you like and the things you don't, the things you feel very strongly about and the things you don't feel strongly about. And that can be an important factor as well, which can stop you or help you in some cases. Inflation is obviously enemy number one. Volatility and taxes, of course, are something that everybody will be sort of familiar with. Now, interest rates, according to me, are connected to inflation. I said inflation is enemy number one, the sort of Duryodhan, if you may say, of the Kauravas here. And interest rates are connected to inflation. Now, interest rates, if you think about interest rates, higher the inflation, higher the interest rates, and vice versa. Now, higher the interest rate, it's good for savers, but it's bad for business, bad for investors. Lower the interest rates, it's bad for savers, but it's good for businesses and good for investors. That's the simple, sort of connection. And that's why, from my perspective, the simplest, it's a very difficult one, but the simplest thing to do as an investor, if you want to be feel in control of the kind of decision making that you do, is to have a sense about inflation and where do you think inflation is going to go? Because if you have that sense, you probably know that where interest rates are headed, and therefore you can then take a call about your investments. I don't think anybody can call inflation into the future. There is enough news all over the world, but you could argue it on both sides. And that's why it is so difficult. And that is also why you don't try to predict stuff, and you simply try and build your process to be as strong as possible. Now, the bias that you will encounter in this second step of the mission planning is herd behavior, right? We know what herd behavior is, just as the word describes it, which is that there's so much information from all sources, especially if you're digitally savvy and you're on your WhatsApp from your uncles and cousins and family groups and friend groups and alumni groups and office groups and everybody putting in information. They're saying, here's what's happening on the border, here's what's happening in US, here's what's happening in the market. And there's so much of deluge of this information that sometimes you get pulled in and sucked into it to say, and you could just display some herd behavior. And you think everybody's talking risk, you also think risk. Everybody's thinking it's a fantastic time to do anything you want to, and you sort of let go of all risk and you go ahead as well. So herd behavior is something that you need to be prepared for. And the question, I believe, that you should be asking for in this particular step is, how do I differentiate between fact and opinion? You're going to hear a lot of opinions from people, but where are the facts? And if you can differentiate between facts and opinions, that's probably a first step for you to, get actionable intelligence. Let's move on and let's look at Irada, the mission statement, the objective, the goals that each one of us have. And of course, you will have short-term and long-term goals in your financial journey. I do think that when you think about your short-term and long-term goals, you should think about it in this way. It's an acronym again called SMART. Just having SMART goals, right? SMART, which is your goals need to be specific, measurable, achievable, realistic, and time-bound. It's not a goal if it doesn't meet all 5 of this criteria. You can't have a goal that's not time-bound. You can't have a goal that's not realistic. You can't have a goal that's not measurable, for instance. At least from the financial journey perspective, I can tell you that in your real life, you can have all kinds of goals that you want to do and you want to achieve in life. But when it comes to financial goals, you need to be able to sort of define it more specifically, be able to measure it, achieve it, be realistic about it, and time-bound. And in that sense, from my perspective, I've always found that the priority number 1 should be retirement, Babu. We talk about, this passion of mine and the firm where we talk a lot about retirement and financial freedom. And the reason I think that we should be prioritizing retirement as a goal is because retirement is the only financial goal for any human being on earth for which you do not get a loan. Let me repeat that. Retirement is the only financial goal in life for which you do not get a loan. You want to buy a house, you get a loan. You want to buy a car, you get a loan. You want to send your children abroad to a great university, you can get a loan. You want to start a business, you can get a loan. You want to get married, your kids married, you can get a loan. You want to retire, you don't get a loan, right? So this is the only financial goal that you don't get a loan for. So it is something that you should put away as early as possible, as much as possible, because, hey, if your kids are going to come to you and say, Dad, Mom, okay, this university and that, and I know that we will all, go through it. I am going through it as well. It's fine. I mean, you would have planned for them and you would have money, but, if you're going to fall short, if you're going to think that there's a stress, if the kid wants to do something more, you can still take a loan and cover the gap. You can't cover your gaps of retirement. And most people then, when they can't cover their gaps for retirement, then tend to either reduce their lifestyle, be dependent on their kids. And I'm sure that, most of us don't want to. There are many who do, and they don't feel anything wrong about it, and many who don't. So it's up to each one of us, but it's just a perspective to have that retirement is the only financial goal for which you don't get a loan. So prioritize that as number one. Now, the bias. In this step, when you're thinking about your goals, the bias that you're going to encounter is something called recency bias, or even something called the loss aversion bias. And by that, what I mean is that the most recent big negative or big positive news will impact your decision making on your investments. Now, you've been talking with your advisor and you've been having a plan for the last 7 years, and the pandemic happens and the market crashes and you say, I'm done, it's finished, it's all over, let's get out, let's take all the chips off the table. And you want to, it's a natural reaction. I'm not saying that, one can be like a robot in some sort. You will react to, but I think the point here is about just being aware. Just being aware that you are being influenced by something which is very, very recent, positive or negative, right? And therefore, the question that you need to be really asking yourself is, how aligned are my priorities and my goals and my, whole decision-making process, right? Have I got my priorities in order? And do I need to react? And if I need to, then where should I first react and not? And of course, one can do that through a discussion with your advisor, and all of that. So this is an important step to remember. Let's move on, and we're going on to Tariqa, which is strategy, tactics, and about mitigating risk. Right? Why do you have strategy? What kind of strategy? In an investment journey? And I think that I'd like to sort of connect it to mitigating risks. That's any strategy that can mitigate risk, any tactic that can mitigate risk is what you should have. Now, let's look at it like this. You've got your strategy building blocks, right? You think about protection, saving, investment, tax, and wealth transfer. This is really the building block of what every investor's journey will be, and in terms of building your strategy. Now, when you want to do that, you have things like the 7 asset classes that you can work with when it comes to investments in between, which is the one that we're talking about, which is equity, debt, gold, commodities, currency, real estate, and alternates. These are the 7 asset classes that any human being on earth has as asset classes to build their investment strategy. Now, a lot of financial experts do not consider, say, for instance, currency as an asset class. But I'm just exaggerating a point, and I also think that from an India perspective, we look at great market returns. We don't realize that on a dollar parity basis, where is our purchasing power going? And the rupee dollar does make an impact. And I'm sure that many of you who have children studying abroad, when you travel abroad, you have business abroad, and you think about it, you do realize that it does make an impact. So I've just put that as a separate unit. But these are the 7 asset classes that you have. Alternates is things like private equity, hedge funds, investing in art, investing in wine, investing in Bitcoin or NFTs, and all of that. All of that comes into the alternate bucket. They're currently alternates. Maybe 10 years from now, some of these alternates will be a standard asset class like equity, debt, gold, and things like that. That may happen, but for now, they are all considered under alternates. And one needs to think about what is the percentage of my 100 rupee investment divided up into these 7 asset classes. That's where the strategy would start. Now, the sequence is important. And I think that's the lesson that I'd like to give on this step of strategy. The sequence is important, especially for retail investors, more than anything else. And asset allocation is the key strategy. I'm sure you would have heard it. It's a dirty word. They call it the A word. But when I say sequence is important, just for a moment, I want to stop and tell you that the sequence is that you first need to think about protection. You think about all your insurances, even if you're a businessman or an entrepreneur. You think about life insurance, you think about medical insurance, you think about general insurance first. Especially, let me talk about young, investors. And if you have children who are just getting into their jobs and they're getting into earning, and you want to give them some advice, I would probably say use this approach. Talk them through the sequence. First, get your protection done, then your saving, which is maybe you can call it your emergency fund, then your investment, and then think about tax and things like wealth transfer. Even the word income tax is income and then tax. Don't worry about tax so much. Think about where you're going to make the income from. Then worry about the tax, and then think about the final thing like wealth transfer. That sequence is important. Asset allocation is a strategy. You try and build downside protection into your tactics. You want to increase your allocation to gold when it is cheap, or you want to make sure that you have your land or whatever it is, which is playing against inflation. Those are things that any advisor will help you go through. Now, the bias that you're going to encounter in this strategy, especially when you're building strategy, is your risk perception. You end up overestimating or underestimating the probability of your bet. There was a point in time when everybody and their uncle and their aunt would be just putting money into real estate, not any longer. Now it's equity, and maybe a little bit of Bitcoin or something like that. And everybody's crying about the low interest rates of the banks and things like that. So, it changes from time to time, and therefore you could end up overestimating or underestimating the probabilities of the bets that you make. And so the question that you only need to be asking yourself is, how diversified and how sequenced is your portfolio. So as I mentioned, the sequence is important, and the asset allocation will come through in the diversification of your portfolio. And that's how you would mitigate your risks and take care of the income. Now let's go on to bandobast, which is your resources, the buffers, and it's nothing simply in the investment journey, but the options that you would have and that you've kept for yourself. To me, here are what I think should be the bandobast of any individual, call yourself an investor or not, but this is what you should have. Your personal health and well-being, number one resource. No point of making all that money if you're going to be stuck to a hospital bed, correct? So, the old and cliched saying of health is wealth could not have been more true. No point in making, as I mentioned, all of that wealth if you are not taking care of your health and well-being. If you're taking care of your health and well-being, 2 things happen. You need less to go by, actually, or you can have surpluses that you can use in the way you want to enjoy life. Number 2, health inflation is the highest cost into older age groups. And so if you are taking care of your health and wealth, you can be sure that you are taking care of the inflation impact of your portfolio into your later years of life. So it helps you both ways. Your personal philosophy is also a resource. I think it's very important to have that personal philosophy. How do you see India versus the globe, India as a part of the globe? How do you think about various asset classes? How do you think about charity, for instance, when you're making money? and all of those things fall into that space. Your personal skills are important simply because that's your primary source of your source of income. So while I talk about sources of income next, I think personal skills are where the source of one of the sources of income where your money is coming from. You could be a doctor or a lawyer or a whatever professional you are, or a salaried individual or a businessman. It's your skills that's getting your money, and you need to think about all of your sources of income: your business, your land, your property that you may have, your investments, all of those. So that's the bandobast that you're doing, that you have. And of course, you have insurance, mutual funds, things like PMS, LRS, which is the liberalized remittance scheme from the government of India, loans, pensions, and of course, making your will. All of those are the pieces that you have, the tools that you have to make your strategy work. Diversification is the only mantra, and concentration is always a killer when you're building it. And the bias, right? The bias that you're going to be probably impacted with in this stage is being captivated by stories. Okay. We make poor decisions while allocating our resources, our hard-earned resources, all of this is our resource. Just because we hear very, very compelling stories. Oh, international investing is fantastic. Oh, Sir Uthake Jio. Oh, insurance. And sometimes all the marketing and the advertising and all the good talk around on various products and options, they simply tend to swing us and influence us. And you could get captivated by the story. But you're going to allocate your resources based on those stories. So again, think about opinions, think about facts, think about what suits your philosophy. I think you would be on a good path. The question that you should be asking yourself is a very simple one at this stage. As you are making those decisions to invest, as you're making those decisions to diversify, and you're hearing the stories about each one of those, you've got to be taking a step back and saying, okay, how convincing is this? Where are the facts for this? Why is this so attractive to me? And let me, before I jump in, think about it and see whether it really makes sense, and what percentage of my portfolio am I going to, expose it to this? In case I'm going to lose it, am I okay? And those kind of things. Is it illiquid? Am I going to get stuck with it? I mean, is it liquid, on a daily basis? Those kind of questions are what you should be thinking about. Now, let's come to the second last one, which is administration, the metrics of measurement, monitoring, the frequency of review. We are almost on the last slide, but let me talk about administration now. Here is where I think that you need to think about your benchmark, right? Every one of us will have a benchmark. Now, you may call the benchmark as, the market, the Sensex or the Nifty or something like that, the government security rate or whatever it be that is your benchmark. And of course, your time to goal. Those are two important things when it comes to administration. To me, I look at the bank FD as a benchmark, because if I was not going to take an element of risk and start investing into various options from equity, fixed income, gold, commodities, currency, real estate, alternates, my money would be in the bank. So my benchmark is the bank, not anything else, right? If I'm making more than the bank, I'm taking decent decisions. I am probably better tax optimized. I am growing my wealth, and I'm hopefully beating inflation. That should be good enough. And of course, the nominal growth of a country's economy is a good number to keep your pulse on. The nominal growth, as most of you would know, is simply the growth rate that you see in the newspapers plus the inflation that you see in the newspapers. That is the nominal growth of the economy. So if you're growing by 7%, and if your inflation is 5%, you've got a nominal growth of 12%. And so you can keep that as a benchmark and say, my equity investments should give me returns over a 3-5 year period of time of more than 12%. And you set your expectations based on that. And that's an important one as you think about metrics of measurement, and not beyond that. Of course, I did talk about inflation. I think you should measure your individual inflation as well. Now, one of the problems that the media, the newspapers, the channels, experts, and people like me, when we do webinars and talk to clients about investing, is that we tend to generalize quite a bit. We tend to sort of hit the high notes, sort of give up some thumb rules. But every individual household, every individual would be very different. You could have a house where you have dependent parents who have medical conditions, and you might have a different situation in terms of cash flow and investment objectives. You could have young children who would be ready to go out. You could have disability at home. You could have various other such issues that happen, and each of that will have an impact on inflation. If there are medical issues, your inflation could be high. If there are children still waiting to go abroad and study or go to colleges in India, in courses that may be expensive than usual, education is expensive wherever it might be. I think those things will affect the inflation of a household. So keep that in mind. The bias that you will have during this step of measuring and monitoring and reviewing is something called result orientation. What I mean by result orientation is that you will, when you're sitting with an advisor and you're looking at your portfolio, you're only judging it by, oh, this is the result I see on paper. It's down 5% or it's up only 14%. The market's like 25%. How come I'm only 14? You're just looking at the numbers. You're just looking at the here and now. And that is a bias. That is a problem that you will face when you're looking at your portfolios. The question that you should be asking when you're reviewing your portfolio is, what were the decisions I thought of and the decisions I took when I made these investments 2 years ago or 3 years ago or 5 years ago? Are those decisions and are those discussions valid? Well, I'm fine with wherever we've reached, because then probably I did do something early on if I had wanted to change some outcome. Maybe I should not have really talked about wanting to go all out into equity. Maybe I shouldn't have just put that money into that fantastic, second home that I saw in an advertisement. I pulled out my money from my retirement account and I did it, and now my overall equity portfolio is down, or whatever it is. One doesn't know. But the fact is, we're talking about biases. We're talking about what can influence your decision. And the point when you're reviewing portfolios, the point that comes up is result orientation. You're just looking at that number and saying, not good or good, or whatever that might be. And you need to be thinking about, okay, what did I think about at the past? So I think that point is made. Let's go to the last point on the Z-Kit bag, and we'll summarize and we'll be out of this soon. Is Ghadi Milao. It's about synchronizing. It's about knowing your commander, your North Star, and it very well can be, your advisor. I'm sure Babu is your North Star, the commander of the portfolio, and just being synchronized is important. So having a third party, a very trusted third party guide you is important, because money decisions have very, very strong emotional influence. There's a lot of direct investors who take decisions about their money. Some get it right, most get it wrong, because they just, swung by the emotion about let's get out of the market or let's get into the market, and things that they read or they hear with the deluge of information. Trust. Right. When you're thinking about third party, when you're thinking about your advisor in this, and with Babu, I'm sure that this is something that is at the back of your mind, and I'm only sort of verbalizing what's already on the back of everybody's mind, which is that you need to have trust. You need to have that third party have empathy, integrity, reliability, competence, and credibility. Right. All of these need to be in. Not just a person who can do great mathematics to you in terms of calculating stuff, but also somebody who can empathize with you to say, okay, we understand where it is, so let's go slow, or let's speed up, or let's hold on. So whatever that might be, there's an empathy, and that can only come from discussions. Machines don't end up giving empathy. So a lot of people invest online, absolutely fine. For a lot of people, it works. Very trustworthy because it's reliable, it's competent, and there's credibility. There's even integrity, you could say, but empathy is what will be the missing factor. And it's a very, very important factor that to have. And at some point, therefore, having a good advisor to guide you through makes a lot of sense. So the bias that any investor would go through in this step is something called overconfidence, which is, well, what it means, which is that the belief that we know how to control the market, and the market is essentially random. Right? We just have this confidence of saying, no, I think that it's all going to be fine. It's going to be okay. Let's just put more money in, or I think this is all going to the dogs. Let's take money out and we'll wait for an opportunity and things like that. And so, what you're trying to do is to try and control an uncontrollable. The only thing that you can control is the process, and you can't control, anything beyond it. So the question that could be very simply asked at this step is, how synchronized am I with my plan, and especially my plan, and of course my advisor. So here you have it. The Z-Kit bag, Zamini Nishan, Khabar, Irada, Tarika, Bandobast, Administration, Khadi Milao, the last step of being synchronized. So I'm going to quickly summarize this, what we went through. Zamini Nishan, your terrain, Khabar, your information, Irada, your goal, Tarika, your strategy, Bandobast, your resources, Administration, your review process, Khadi Milao is your discipline that you will need to maintain at some point. Right? The challenges that you're going to face is the home bias, which means that you could possibly, while looking at your terrain, be looking very narrow. I think one can take the approach of widening your scope when you think about investments. When you come across information and cover that step, you're going to be caught into herd behavior and chasing returns. Be very clear about your filters. You need to know what is fact and what is just opinion. Look at your goals. You're going to be hit by recency bias, especially whatever is happening in the short term, positive or negative. It's going to affect you. Just make sure that you're prioritized, that you're sequenced, and you know what you're going after. The strategy, it's the risk perception that's going to hit you pretty much. So don't end up oversimplifying some of the stuff. And the easiest way to take care of the strategy is, all the building blocks. Just make sure that your allocation, the percentage of allocation is well balanced. That's the best that you can actually do. They say that asset allocation, or rather diversification, is the only free lunch in investing. So you might as well eat as much as you want. So the tarika and the strategy and about diversification is one lesson. When it comes to resources that you have with yourself, the story is going to influence you, and hopefully you don't do any wrong resourcing. So make sure that you've got your sequence right about how you're planning for yourself and looking at all the facts, as I mentioned, rather than taking opinions. When you're reviewing, be careful that you might be looking at the result as is and not thinking and reacting to it, rather than reviewing your decision making, which got you here in the first place, and to think whether you did anything right or wrong in that process, and then reviewing that action. And the last is Gadi Milao, or synchronizing your plan. And over there, you're thinking about not being overconfident, and don't be trying to control randomness. And so having a sync with your advisor is good. So here's a fantastic framework, and I hope that you found that enjoyable in terms of just listening to how you can use this framework for your investments. Let me tell you that the Army has another quote, and that is, the battle plan is the first casualty of war, which essentially means that, when you're getting into the war, all your plan, but the battle plan becomes the first casualty. You've gone in thinking of everything, and it starts raining, and one didn't think of that. So, anything can hit you. But it's important to, have a rough and ready plan in your head. I don't think it needs to be cast in stone, but I think it's something, which sort of helps. And one of my favorite authors, Morgan Housel, when he talks about wealth creation, wealth management, or making money or making wealth, he says that there are simple 4 steps that you follow. One is spend less than you earn. It's like the grandmother's advice. Okay, spend less than you earn is the first step. Very, very tough for many youngsters and many people. Second is save the difference. If you spend less than you earn, to make sure that you save the difference. Third is take the help of a trusted advisor and invest in a diversified portfolio. And the fourth is have patience. If this is the 4-step magic formula to any money creation. Spend less than you earn, save the difference, take the help of a trusted advisor, invest in a diversified portfolio, and have patience. Step number 1 and step number 4, very, very difficult. So thank you, ladies and gentlemen. Thank you, Babu, for that opportunity. I think I actually took, probably 45 minutes after the introduction. I thought I'll take about 35, might have gone over, but I hope that's useful. I'll stop sharing, and Babu, over to you.
Yeah, thanks, Ajith. Outstanding. I got a feeling that I was, in the army front, somewhere in the camp, discussing a kind of thing. Awesome, Ajith. I know you're a speaker, but you keep excelling yourself every now. So thank you so much. What a wonderful framework. I mean, just to tell you the truth, I am in this line for the last 2 decades plus, but it's a lot of learning for me too, Ajith. Thank you so much for this wonderful. Friends, the question, the chat window is open, so happy to kind of take questions. Ajith, I have a question that I'm going to start with while others get their questions ready. sometimes, especially in times like these, one feels, that one needs to take a decision. And you rightly mentioned sometimes that patience is needed, right? And we know in the industry, and one of the quotes that the mutual fund industry often quotes is that the best returns are often made by the dead investors, right? People who never get out make the best returns, is what most mutual fund houses have revealed to us, and the statistics tell us. But in times like these, when the markets are up, and sometimes you feel that edge, as an investor, sometimes even as an advisor, you want to be seen to be doing something, right? So that you're not caught in the wrong side of things. How do you curb that action and say, patience is the virtue? It's nice to say, but it's difficult to kind of be patient and be silent while you see these ups and downs. So how does one kind of I know meditation is one way, but is there something else that we should kind of follow?
Well, I think, from my perspective, Babu, the way I have dealt with it, and I would like to answer this from, my personal perspective. I use an advisor for the last now maybe about 9 or 10 years. I have a financial plan to which and my wife, we are together and we review it every 6 months with our advisor. We have plans like, my daughter's gone abroad for her studies. My son will be ready in 5 years, our retirement goals and things like that. And I think I look at that step where, I go back to review my decisions when something is happening. So when I'm hit by an urge of saying something's going to go terribly wrong, and I think the pandemic was a great example of it. And right now, this anxiety about all of this money printing by central bankers, this is going to go and blow up in some, runaway inflation, and what will happen? And you start thinking about things that worry you about your investments. And I think the best thing I do at that point of time is to bounce back on the philosophy that we started the investment plan with, the sort of premise that we had put our plan on, to look at that percentage diversification and look at each one of them and say, okay, where is it that I need to make a change or not? And then boil it down to, okay, I don't need to do anything about my insurances. Maybe I need to top up my health insurance, and those are decisions to take. And I did top up my health insurance during the pandemic. And then you look at your emergency fund and you say, okay, your emergency fund is like 6 months expenses. Let's bump it up to 9 months. Okay. And I look at my, that, and then I take that. Then I look at the investments and say, okay, don't have to worry about all the investment in gold ETFs and stuff. It's going up and down, but gold is a investment for the very long term, and you feel comfortable about it. Even though it's not given great returns, also it doesn't lose too much of its value as well. And then you have your real estate is fine. Then you come only to your equity, and your fixed income, and then you boil down your decision to this. Now, when you talk about patience, when you talk about the urge to do something, many times people just rip everything apart and start from scratch, or do something of that sort. If you are reasonably planned about your investments in the first place, I think that you can then simply revisit the premise on which you took your earlier decision, and then narrow it down to the one area that you want to take one or two actions. There's nothing wrong in taking that action. Like I said, I increased my insurance, and I also, removed some of the money from my investments to increase my emergency funds. And then as far as investments is concerned, I sort of took away money from thematic products and went into more diversified funds. I didn't go all the way large cap, but I got into more diversified equity funds. I definitely increased my international fund exposure. Thankfully, we had our own funds to do that as well, and so on and so forth. So long story short, I think it's you cannot overcome that human tendency to want to tinker with something, but it's about the whole process of tinkering. Do you have a plan to the tinkering? And revisiting your earlier premise, taking it in the sequence that I mentioned: protection, savings, investments, tax, wealth, and wealth transfer. So you start thinking about where you want to, in the sequence, go and make the change, and then take the decision. Once you take it, go back to your job and say, yours is done, and you don't need to do anything more. So I hope I've answered it in some way.
Super. Thank you so much. And in fact, it's So here and after, whenever a client or we are tempted to do an action, we're going to first go back and go through the premise. And if that premise needs a change, then we will kind of make the action. Otherwise, kind of stick on to it. Great. Thank you so much, Ajith. Lots of comments coming in. Ganapati Venkatraman says, I feel like a first-time trained commando. Yeah, absolutely. We all do, Venkat, absolutely. A well-synchronized defense and investment strategy goes well together. Thank you very much. Harinath has this question. What is the best way to be invested in a global market? Give us some insights, Ajay.
So, I think the premise of investing in international investments, I think, is pretty clear. I'm sure that all of you agree to, why you want to do it. There are many companies and sectors and stocks which are available internationally, which are not even represented on the Indian stock market, which make a lot of money. So whether it's e-com like Amazon, whether it's streaming companies like Netflix, whether it's luxury companies like Louis Vuitton, whether it's payment companies like Adyen, which is basically powering the back-end payment for a lot of people like Uber and all of that. Digital payments is a big area. And there are many such health tech areas and the others which are not available on the Indian stock markets, and they are high growth areas all across the world. So the whole point of investing internationally is because of that. How do you do it? Indians have two ways to access it. Your first simplest way is to choose a good international fund, international feeder fund, and I'm sure Babu can help you with selecting many. There are about 34 or 35 such international funds in the Indian market. My recommendation has always, in my experience, been just go with a good diversified global fund. Don't go into a fund that says, oh, I think the US is the most powerful country on earth and they're the biggest in the stock market, so let's go there. Or let's go to China and it's going to be the next big, or Europe or whatever else. Let the fund managers internationally, decide in a global diversified fund which country, which region, which geography, which theme should be invested into. And if you get a good portfolio, that should be good enough. So you can use the feeder fund route to invest into a couple of good global diversified equity funds. Your second route available to you from the Reserve Bank of India is the liberalized remittance scheme route, LRS. And that allows each individual Indian to invest up to $250,000 per person per annum into international stocks, funds, or other investments. There are many people who offer those investments as well. And of course, Anand has just reminded me that on the group that, the NSE is come up with options to invest in some of the global stocks as well. And does this change anything for international funds for Indian investors? It doesn't. If you're happy to invest in those options that the NSE provides, you can very well do. But my recommendation to an investor will always be go with an active fund. Go with an active fund which has a fund manager sitting there day in and day out, looking at the portfolio and deciding whether they should be getting out of China or getting into India or getting, increasing their allocation to healthcare or decreasing it to technology and whatever it is. So let the active fund manager take that call. And I am not so much in favor of indexes or ETFs. They definitely play a very important role. But I think that when it comes to thematic investing, or I won't call it thematic investing. I would call it tactical investing as part of your strategy. It's always good to go with active funds. So I hope that answered the question. Babu, over to you. Any other questions that you want me to take up, or so? And be fine.
Absolutely wonderful, wonderful, Ajith. I think we're well beyond, 6 minutes beyond the time normally that we kind of wind up. So thanks a ton. I think it's been a fantastic session of learning for all of us, and thank you so much, Ajith, for sparing your Saturday evening and being here with us. And thanks to all the people for joining in Finsherpa Academy once again, and kind of hope you found this useful, and look forward till we meet again. Thank you so much. Have a great weekend, and very, very happy 75th Independence Day to all of us. Thank you so much.
Exactly. Happy Independence Day to all of us.
Yeah.
Bye-bye. Take care.
Thank you, Ajith. Thank you, Rakesh, Selva from Team Pijim for
Thank you, sir.
wonderful. Yeah. Thank you so much, guys.